Hi, welcome to another episode of Talking Tax with Alex. In this episode, we're going to quickly review why I chose this case again. We're looking at the same court case as last time. We're going to quickly recap the original ruling, and then we're going to explore the alternative issues and the alternative ruling, and wrap up with some closing thoughts. So, we're using the same case as last time, except we're exploring alternative arguments. The taxpayer put forth a couple alternative arguments as to why they were entitled to the engineer's deductions on their business. And those arguments revolved around sections 174 research expenses and RevProc 2050 software development expenses. And the arguments kind of get a little bit out there. And so I thought this was a fun case to kind of go a little bit deeper in the tax code and explore some concepts that are not quite as widely known. So I hope you guys enjoy this. Again, the reference for the court case, same court case as last week. So we're going to quickly go through the facts and quickly go through the original ruling just as a recap. If you want to hear more explanations on the original one, please look at the video from last time. It's going to be linked in the comments or linked in the description section. It'll be linked in the video. So just go ahead and rewatch that video for the original facts, rulings, and discussion on that. But real quick, so this taxpayer in 2015 developed a software company and hired engineers with future monetization plans, and that never happened. The future monetization plans didn't happen until 2019, but they did release the website to the public in 2015. So what was argued was, are these expenses allowed? Are they allowed in 2015? Are they not allowed until 2019 when the company made money? That was the original court case. That's what was being argued, is what is allowed and when. And so the original ruling was that about $8,000 of business expenses were allowed in 2015 because just as a television station can have no viewers until it begins broadcasting, the court found that the website Visala could have no users until before it opened the website to the public. So that made it so that there didn't necessarily need revenue for the website, because they found that the website was not a traditional archetype for a store, in that a traditional store needs to have revenue, not profits necessarily, but revenue, before it can be counted as being in business. And the reason why is because the taxpayer prioritized building web traffic over revenue to create a user base. And so this is common in the digital era. Websites, digital products typically release their products to the public first and then monetize later. And the courts found, again, that once the website was made available to the public, that it is open for business. The original ruling also found that most of the remainder of the expenses before the website was made open to the public were allowed as Section 195 startup expenses. And so just a quick recap, Section 195 startup expenses they're allowed, but you have to amortize them over 15 years. So it takes 15 years for you to recoup the tax benefit of those expenses. That sucks. And to make matters worse, the court found that there's a $5,000 provision where you're allowed to take $5,000 of these startup expenses in the current year, typically, if they're under the $55,000 total, what you spent. But the taxpayer couldn't establish that they spent more or less, more than $55,000 on startup expenses. Therefore, they weren't allowed any startup expenses, and all of it had to be amortized over 15 years. And then finally, in the original court ruling, $573,000 of Verizon cell phone and internet services were allocated and allowed as Section 162 business expenses, but that meant that 1,200 of those were disallowed as personal expenses. So it's not like it was even allowed over 15 years, it's just disallowed entirely. And the court found a ratio, or calculated these ratios based on the weekly work hour estimates that the taxpayer provided. All right, so that was a recap for last episode, and I want to go. I'll slow down, and I want to go into the alternative issues and the alternative arguments, which revolved around the taxpayer claiming that the engineering expenses, which are the vast majority of the expenses, I think of the $25,000 total, I think it was $16,000-$17,000 of it. So the taxpayer was claiming that, okay, even if I wasn't allowed 162 business expenses for these engineering expenses, I should be allowed to take these expenses as 174 research experimental expenses. So, interestingly enough, 174 research expenses are specifically excluded from Section 195 startup expenses. So this is important because the taxpayer is arguing that, well, now that I've been ruled that some of my expenses, majority of my expenses are 195 expenses, well, actually they should be counted as Section 174 research expenses. And so 174 states that you're allowed R&D expenses for a trade or business. So this is like a separate section of the tax code that's different than Section 162. 162 allows for ordinary and necessary business expenses, that you're allowed to write off ordinary and necessary business expenses. 174 is really based on research and development, but R&D is a separate animal in the tax code. So R&D itself has its own code section, and really 174 is actually about the R&D credit. So the taxpayer making this argument that they're allowed, research expenses under 174 it's kind of out there. Like I think it's a really good effort. It's a good try, but we'll see why it doesn't hold up in a second. But they're saying that I spent research and development expenses, and therefore I'm allowed to take these deductions. However, so Section 174 R&D expenses and this whole code section, this whole 174 thing is all related to the R&D tax credit. So to put it kind of quickly, the tax credit revolves around what kind of expenses you spend, and if you spend them correctly in a certain way that matches the code's definition of what research and development is, then you are allowed to count them towards calculating the credit. We're not going to go there here. So we'll do R&D credit maybe at some other point. But the fact that this tax code, that this section came up in this argument, I thought was very cute. And it's a good introduction and a way for us to kind of discuss a kind of a nebulous place of the tax code, research and development. What does research and development mean in the tax code? Like I said, we're not going to dive into the full. We're not going to dive into the full definition of it in this episode, but we're going to cover what is uncertainty. So the regs are provided by the IRS to clarify what the code section says, and so a reg for 174 says that R&D needs to be used to eliminate uncertainty. What is uncertainty? Uncertainty is uncertainty is a defined term in the tax code. So uncertainty means that there's no established method for development of the product. Still kind of wide open, still hard to interpret, but we're kind of narrowing down what research and development really means. And so hopefully we're starting to see that, well, okay, did the taxpayer encounter uncertainty? Did the taxpayer have an established method for developing his software platform? Well, we'll see, but this is where the code is going. These are the questions, and this is the argument that is being framed up. And so you think, and I think this is a really great example too, when you think about the tax code and you're trying to apply something in layman's terms, you say, yeah, research and development. Yeah, of course, if you're paying for an engineer, a software engineer to code something, of course they're doing research and development. Well, research and development has a very different definition in the tax code. And one of these requirements is you need to be spending research and development expenses to eliminate uncertainty. Uncertainty means you have no established method for development of the product. The other issue, and the other alternative argument, is taxpayer pulled out RevProc 2050 for software development expenses. So RevProc, short for revenue procedures, is very similar to regulations. It's another published document by the IRS that gives guidance on any certain issue. In this case, this RevProc gives guidance on how to treat software development expenses. And also just a quick tidbit, RevProc, so when they call it RevProc and then 2050, the way that they label these, 2000 is the year that the RevProc came out, 50 is the number of RevProcs that had come out in that year up until this one. So this RevProc is from 2000, the year 2000. That's 22 years ago. That's a long time. So this taxpayer is pulling out some basically a rev procedure for software development expenses from back in 2000, right? Like that's a different world. That's a different life. Software was at its infancy at that point in development and all that stuff. And then the tax code also needed a lot of guidance on how to treat software because up until that point, software wasn't a large driving factor in the economy. It wasn't a large taxable entity. I mean, maybe it was just starting to become big at that point, but it's nothing like it is today. And in this RevProc, it says the IRS will not disturb a taxpayer's immediate deduction of certain non-Section 174 R&D costs. So the taxpayer is basically saying that even if my engineering expenses are not 162 expenses and they're not 174 expenses, they count as RevProc 2050 software expenses. So the taxpayer is coming at it with three angles, three different arguments, and saying, hey, I deserve it because I deserve the deduction because it's ordinary business. If it's not that, it's due to being research and development. If it's not that, well, RevProc says that the IRS will not disturb my deduction if it's not an R&D cost. So taxpayer is trying. I give him credit for that. And this RevProc basically mimics the 174 exception of capitalization rules of 195. So 174 is basically saying you don't have to capitalize startup expenses. So remember, Section 195 is our startup expenses. Capitalize means that you need to accumulate your expenses, but then you get to amortize them over time. That's why 195 expenses, you have to take them over 15 years. That's called amortization. You have to take a little piece each year. You don't get to take it all the time. So this RevProc is basically saying certain expenses that are not 174 expenses, 174 research expenses, also get to not be counted as Section 195 capitalization expenses, startup expenses that have to be amortized over time. That's the other argument here. So, what did the court rule? Ultimately, that uncertainty was not encountered. How did the court rule this? Well, the court pointed to two other court cases that evaluated the R&D credit and the application of the R&D credit. One case where the R&D credit applies, one case where it doesn't. So, in the first R&D credit example court case that they cited was that this was an R&D credit court case for software to automate a business. So a taxpayer basically paid to have software developed to automate their business. This automation was going to help the business improve their processes and their integrations and all of that stuff. So it does sound kind of similar. I mean, obviously this is software to automate a business. The taxpayer's case was it was a web platform to aggregate data. So a little bit different here. But the court was drawing a parallel here, saying, well, this is a similar case where a taxpayer is paying for software. software development, excuse me. So they're paying for engineers to develop software for them. That does sound kind of familiar, right? And in the process of developing this software, they hired contractors, and these contractors used standardized industry best practices to develop the software. So remember, we were talking about uncertainty, and there needed to be no known development process for how to develop the product or whatever. Oh, okay. In this case, in this court case, the taxpayer did use standardized industry practices. Even worse, the contractor they hired used commercially available software application suite. So this would be something similar to like Oracle or NetSuite or something like that, where the taxpayer, your solution in the software is not new software, it's configured software. So it's software that a contractor or someone who's really familiar with can use to form to create a solution for you within the existing code of that software. So it's a lot different than developing your own code, and I don't know enough about coding, so I'm just going to kind of stop talking before I get out of turn here. But from my very basic understanding of it is they're not developing a new software from scratch. They're using a commercially available application suite, which is like NetSuite, Oracle, or something something like that. And then they build a solution within that environment. And then finally, this development process was apparently followed in service of other clients. So not only did they use industry best practices as contractor to develop the automated software for this client, the contractor used commercially available software application suite to do it, and they developed this development process that they used it for other clients. And so in this way, and we can kind of see now that there really wasn't any uncertainty in the development of the product, right? The development of the product was pretty certain. The contractor had done it before. They used software that was already available, and they followed industry best practices. So we can kind of see, on this one hand, there was really no uncertainty, right? Like, and this is this example of the court case is where the taxpayer was not allowed the credit. The second example here is where the court cited that the R&D credit was allowed. And so, starting off, the taxpayer did not know the steps or how to make the product commercially viable. So that's a lot different than our current taxpayer for Visala, the one that is using this alternative argument, who they already kind of know that they're developing a software platform, and they hired engineers to do it. In this case, for 174 to apply for the credit, this taxpayer did not even know the steps on how to make it commercially viable in the first place. Their hardware was proprietary, and they required custom tests. So they really had to go to the drawing board and determine how to code things so that they can get the correct output with their proprietary software. So remember we were talking in the previous case where the developer used a commercially available software application suite. In this case, the company is using their own proprietary hardware to run tests and to try to figure out how to make a product that's commercially viable. And then the software engineers tested the computer code on their hardware to get the components timing within milliseconds. So there was a lot of uncertainty. So now we can see the differences, right? We can see on one hand, the first court case, there's a lot of certainty on how to develop the product within the tax code's definition of it. And on the second hand, with the second example, you can see how the taxpayer really didn't know how to make their products viable. Like they had to use their own proprietary hardware and had to test their code a lot to get timing on the hardware to be within milliseconds. So I hope I hope this really illustrates the two examples here. I know it's getting a little bit technical, but I think we can just sum it up with 174 applying to research and development. In this aspect, you need to prove that there was uncertainty in developing your product, and the court ruled that there's not. The second argument, the Rev Proc 2050 alternative argument that the taxpayer made, where they said that even if it's not 174 expenses or 162 expenses, they should be allowed the deduction for Rev Proc under Rev Proc 2050, because the IRS should not disturb a taxpayer who is is currently deducting their expenses. So the taxpayer's argument was that this Rev Proc basically guaranteed the allowance of the deduction. However, I just quoted it here. I think this is the best summary of it. The court came up with, but basically, they reject the argument because the taxpayer never demonstrated that they are entitled to the deduction. So it's kind of ironic because the Rev Proc says the IRS will not disturb any taxpayers currently taking the deduction, so long as they're allowed and entitled to the deduction. However, the court just says, well, taxpayer hasn't actually demonstrated they're allowed to the deduction. They're not allowed to the deduction under 162. They're not allowed the deduction under 174. Why would they be protected for the deduction in the first place? So, ironically, this guarantee didn't actually hold up because there's a guarantee to nothing. So my closing thoughts are that uncertainty is what the code says it is, and that means that within the research and development section of the code 174, uncertainty is really a defined term. We looked at the court case with the taxpayer that wanted to develop software to automate their business, and in doing so, they hired a contractor who effectively followed a known path, industry best practices, using a commercially available software, and used a process they developed that they use for other clients. So the process to develop that as it applies to this taxpayer, who's very, very similar in this way, we can see it. They hired engineers, and the engineers knew how to develop the website for them. It was very clear that there was no uncertainty. There was no uncertainty in these expenses as it relates to the research tax code of 174. Another quick note is that as of 2021, the R&D expenses can't be deducted anymore, and they must be capitalized. So this is actually a very recent tax code change, and I didn't want this to detract from the video, so I didn't bring this up till the very end. But what we were talking about with Section 174, allowing those deductions, so that's not allowed anymore. Now, Section 74 is really, really just focused on the R&D credit, and if you want to qualify your expenses under that code section so that you're allowed the credit. So this argument applied in the 2015 tax year, but it doesn't apply as of 2021. And finally, I think order of operations needs to be underscored here. You need to establish the right of the deduction first, as we saw in Rev Proc 2050, which the IRS will not disturb any taxpayers who are currently taking deductions that are not 174 expenses. It's almost like a guarantee, right? The taxpayers were to be allowed to take their deductions if they were allowed those deductions in the first place. Taxpayers, the IRS would not force them to capitalize it. Well, as we learned here and saw in the court case, the taxpayer in our court case couldn't establish the fact that they had a right to the deduction in the first place. Therefore, they weren't allowed to have that guarantee, and the Rev Proc that they cited ended up being a moot case. So that's it. That's the end of this episode of Talking Tax with Alex. If you like the content, please like the video. subscribe to my channel, and comment. Leave a comment below or email me your thoughts. I'd love to hear what you think about these episodes, get your feedback, and collect comments and ideas for next episodes. My email is talkingtaxwithalex@gmail.com. Thank you.